Do you hold real estate investment trust? Do you know how to report your income and IT return? This year, make sure your IT disclosures are aligned with the latest tax rules. Real estate investment trusts are considered as business trusts under Income Tax Act and are presented with pass-through status. This pass-through status means that the income earned by these trusts will not be taxed in their own hands. It will be taxed in the hands of unit holders or investors. Some of these income are taxed in the hands of unit holders, others are exempted. A person holding REIT can earn interest, dividend, rental income, and lot more on quarterly basis. Let's see the tax status. Interest income. This is taxable for all unit holders. This income achieves pass-through status when business trust receives this amount from the SPV. TDS is also deducted at 10% for residents and 5% for non-residents. Next, dividend. There are two options available here. If the SPV of the business trust opts for concessional tax rate, then the dividend is taxed for unit holders. If it is not opted, it is exempt. This income achieves the pass-through status when business trust receives this amount from SPV. TDS is applicable only when the amount is taxable and at 10%. But how do you know whether the REIT is taxable or exempt? Your REIT will provide you an advisory every year. This should be received by you through mail. Just rental income. This income is earned by the REIT directly by owning real estate properties, letting out for rent or lease. This is distributed to the unit holders and it's taxed at slab rate under the head income from house property. TDS is also deducted at 10% for residents. Next is gain on sale or disposal of business assets. It's capital gain for trust, but for the unit holders, when it gets distributed, it is exempt. Next is other income of business trust. It includes income other than dividend, interest, and rental income. This is taxable to the trust at maximum marginal rate, but when distributed to the unit holders, it is exempt. Next category is repayment of debt or reduction. This is taxed under the head income from other sources and computed as per section 56.212 or 92.2K. Earlier, this amount was considered non-taxable and was reduced against the cost of acquisition of units. Now, it is directly taxed, but only when the distribution amount exceeds the issue price of unit. Next is capital gain on sale of these units of REIT. This gets treated as long-term when it is held for more than 12 months. If STT is paid, it is taxed at 12.5% on gains exceeding 1.25 lakhs. If STC is not paid, then a flat 12.5% tax is applied. If it is held for less than 12 months, it becomes short-term and it gets taxed at 20% if STT is paid and at slab rate if STT is not paid. Every year, business trust has to file a statement to the department and provide a copy to the unit holder in Form 64B. It gives the details of the nature of income paid during the year. It helps in classifying the income into taxable and exempt. Next, the disclosure in IT. Interest income, dividend income is shown under other sources. Rental income is shown under house property income. The exempt income are shown under the head exempt income. This repayment of debt comes under other sources. Capital gains gets shown in capital gain based on long-term or short-term. There is a special schedule called Schedule PTI available in the form ITR-2 and 3. This particular schedule is to consolidate the income received from REIT along with the TDS spent. It is mandatory to show all the pass-through status income in this schedule. Details are provided on entity-wise. Name of the REIT and PAN with amount under different heads of income and TDS are to be mentioned in this. Next, this page shows you the section numbers available to fill in Schedule PTI. Just have a look. And I have given a summary of what is taxable and what is exempt and what is the disclosure in IT form. Hope this video is useful. Leave your comments for more video on similar topic, and thank you.